Hello, I'm Mark Lowdy. Here's a question for you. Should you still buy and hold your investments? All too often nowadays we see on the major financial channels commentators saying that buy and hold is dead. You should be trading. You should be actively managing your portfolio, reviewing it very frequently just to make sure that it's still in line. I'm joined by Manpreet Gill, who's with Standard Chartered. He is a senior investment strategist there with the Group Wealth Management Division. Thanks so much for coming in.
Thank you.
I get the feeling that sometimes you hear these commentators say buy and hold is dead because they want to make more money on the trades. Is that perhaps too cynical, or is there still value in buying and holding?
No, we firmly believe there is still value in buying and holding. It's a bit like the stock phrase, this time is different. It's not different this time, and we don't think it'll ever be different. There is always room for some trading, in any good portfolio when there are sort of short-term opportunities. But we believe for a core asset-allocated long-term investment portfolio, we believe, looking for value with a view to sort of generating long-term investment returns is still the right sort of lens to think about how to manage your money, especially the bulk or the core of your investment portfolio.
And the experts have it wrong? What happens if the market moves against you and actually the value of your investments falls? Isn't that a worry?
It is a worry, and to some extent that's why the tactile overlay is important. We do obviously look at markets on a month-to-month basis. We think about whether there are short-term overlays and opportunities that we should be taking advantage of, and we recognize that markets can deviate from the long-term fair values for long periods of time. But having said that, we don't think this is not new. This has happened before. This will happen again. What past experience has shown us is that the bulk of investment returns over the long horizon usually arise from an investor's asset allocation decisions. And we believe that this kind of environment doesn't mean that we should throw out a long-term investment approach. Simply because we're in a period where some of the shorter-term sort of difficulties have kept some of the asset values down.
I see. So it's not about picking stocks, but about broadly allocating your funds among different assets. What sort of assets are you referring to?
Well, one of the most important decisions can be, at a very high level, how much do you allocate between different asset classes? How much do you allocate to equities, to fixed income, to commodities? And when you're thinking about your total investment returns of your portfolio, that can actually be as important, if not more important, a decision as thinking about which stocks or bonds to pick. And I think that's a very sort of important point that most investors tend to overlook when they're thinking about, should I be looking at stock A or bond B or commodity C?
Still, for many retail investors, buying a stock on the market is actually relatively simple, or buying a mutual fund, let's say. Buying commodities and bonds for the man in the street is much more difficult. How do you suggest in practical terms that they can go about doing that?
Well, there are many practical ways. I mean, I agree that these asset classes, if you want to buy the commodity or the bond directly, it can be challenging. Minimum sizes can be large, or in the case of some commodities, you always end up buying the futures. But obviously there are many, good implementation approaches even for retail investors. I mean, there are a number of, a fund-based approach, for example, or a sort of ETF.
Like a unit trust.
Unit trust, or even, listed exchange-traded funds, or even within the equities universe. I mean, if you're trying to take exposure to commodities, for example, you can get at least part of that exposure to companies, linked to that commodity or interest rates.
I see, like Noble Group, like Olam International.
Absolutely. I mean, there are many examples, good examples out there of companies that will allow you to sort of gain at least partial exposure, even if you're trying to sort of get at another asset class. But in many cases, investors should, try and sort of have, even if it's a fund-based or a unit trust-based approach to the other asset classes, not rely on, just equities with exposure to different asset classes.
Let's now move on to value. You said you can still find value, buy things when they're cheap. But how do you determine where value is represented, what a bargain is?
Well, if you take the equity market as an example, it's actually relatively simple. We use a relatively simple basket of metrics. I mean, the PE ratio is something most investors will be familiar with, most equity investors will be familiar with, and on that basis, you can find a lot of value in equities. We believe there's value in equities as an asset class. We believe a lot of that value is actually much more so in the developed world today rather than the emerging world.
Really?
Absolutely. And
we always think that emerging markets are the undervalued ones.
Absolutely. And I think this is why it's important often to take a look at these metrics, because intuitively a lot of the excitement today is about emerging markets, because that's where most of the growth is. But if you think in terms of value, in terms of PE ratios relative to where markets usually see the long-term average levels, US equities, for example, still look very attractive. I mean, simple PE measures are still still well below the US market's long-term average. So to us, that represents value. It's not, it's often about growth, but it's also about how much markets are pricing in. And that's why it's important to think about value versus, what's the growth story.
For the man in the street who's just starting investing, figuring out what the PE ratio should be is often a challenge. It's not like price to book value, let's say, where anything below 1 is cheap and everything above 1 is expensive. With PE, how do you draw the line and say, well, okay, 12 is cheap, but 14 is expensive, for example?
Well, there are two ways we look at it. I think one is to look at a market by itself and say, well, where the number is today, is it very far above or below its, the market's historical average? So, for example, if U.S. equities today, the PE is the forward PE is about 13.6. That's actually a little bit below the U.S. market's long-term average. That suggests that, yes, there is some value. It's fine to combine it with other metrics like price to book. If price to book of a market is very, very low, again, relative to that market's own long-term average, simple average. These are sort of some very simple ways to think about where a market's offering value or where a market might be very expensive.
When you talk about value and investing for value, do you then necessarily sell as soon as the PE ratio reaches that average? Or do you then continue to hold and continue to hold and continue to hold?
Well, no, we're not blind to what's happening in the market today. I mean, you could, if you rely strictly on value alone, you could end up holding cheap markets for a very long period of time, and markets can stay cheap for long. And Europe's a great example. If you are a very long-term investor, I mean, European equities are very, very cheap. But the fact is, we know that they'll most likely continue to stay cheap until policymakers actually deal with the crisis and the issues around that. So, it's a question of finding value, but then it's about not being blind to the tactical decision as well. Unless, of course, investors have a very long time horizon. If you're thinking about more of a multi-generational environment, you want to leave money for your kids, that's the kind of environment where possibly you could think about, not worrying about the short-term element. But anything shorter than that, you would still need to think about whether tactically you'd also want to get in, whether there's other good news around it.
Lastly, then, when you look at most retail investors in Singapore, their biggest asset is their property, is their HDB flat, is their private condo, if they own one. Therefore, arguably, they have an overexposure in property. But then again, you can't just sell your HDB flat because you want to invest in the stock market. So how do you deal with that in an asset allocation way, where you say, okay, you do have a large part of your wealth tied up in your HDB flat, in your private residential unit. What should you then do with the rest? How do you negotiate that as a wealth planner?
Well, the way we look at it, we don't really, consider physical property to be part of, let's say, an investment allocation. It is part of, an individual's or a family's asset allocation in practice. But in reality, like you said, are most investors going to be selling their house in order to trade that money in the stock market?
Hopefully not.
Hopefully not. But so the way to think about asset allocation is maybe to just start simple. Look at the actual amount of investable assets that are out there, and look at that as the investment portfolio in which to take the asset allocation decision. That's the first point. And second, maybe think about where you in a sense have these forced large exposures. If you have a large exposure to real estate, through ownership of your home, maybe you should be using your investment portfolio to diversify and take exposure asset classes that are not real estate. So don't buy more Singapore developer equities, because the exposure is the same as the money tied up in a house. Think about buying U.S. equities, which hopefully have nothing to do with how the value of a property does. Think about commodities or fixed income, which again should not move in sync with the value of your property. That's using your investment portfolio to achieve diversification.
Great to see you. Thank you so much for coming in today.
Thank you.
Manpreet Gill from Standard Chartered. And Singapore Investment Week is on. The details for the website are on your screen now. 25th to the 31st of August. Make sure that you take the opportunity to find out more about investing. I'm Mark Lowdy. Have a great day ahead.